get started. We're fortunate to have a guest lecturer here today to take us through some of the financial statement stuff. I'm going to set the stage a little bit, explain to you what to expect for class today, and then I'll introduce our guest and turn it over to him. We will go over the financial ratio analysis stuff from, I believe, chapter 3 today. At the end of class, if you have any questions, I can go over any of the quiz material or any of the homework you had for class today or any of the previous 2 classes. There should be some time at the end of class for us to go over that and answer any questions you might have as you're absorbing the material to get started. For today, we'll do analysis of financial statements, talk about ratio analysis. So you all do a little bit of ratio analysis in 501? A little bit? Okay. All right. Maybe our guest will ask you some more questions about what exactly you did and how that worked. But we'll talk about ratio analysis specifically, focus a little bit at the end on this DuPont system, and discuss some of the nuances and limitations and so forth with that. To put this all in context, as you know, I love this slide, which comes down to determining value. Value for a company, value for a project that your company might be evaluating, or value for your personal investment. So everything we learn in corporate finance in this class will in some way contribute to this. In class 1, recall, we learned the basics, time value of money, the cash flows we get in this project, or for this company, or for this personal investment. If we had them all in our pocket right now, they would be worth more money, but since we're not getting them for years and years later, there's a couple problems with that we want to account for. 1, time value of money. We can take that money and invest it somewhere else. 2, the risk factor. We don't know what's going to happen in 10 years. We don't know what's going to happen in 20 years. We especially don't know what's going to happen in infinity years. So that cash flow, those cash flows are worth less in our calculations when we're determining value. Recall in class 2, we talked about how we can look at financial statements, look at the sales revenue, make some adjustments, determine a free cash flow figure, which is the amount of cash going to the debt owners and the equity holders of a company. It's calculations to get to that number, and then we ran that through our time value formula, and that's getting us closer to this idea of what is the value of this project, company, or investment. For the rest of class, and not class today, but the rest of the quarter, we'll talk about this stuff that goes into our weighted average cost of capital, the amount of risk in the market. I think we'll start talking especially about next class, interest rates, the firm's debt equity mix, how the debt holders have different expectations than the equity holders. Sometimes if we have a whole bunch of debt holders, that can increase our risk. I mentioned the Donald Trump casino example where he was paying an exorbitant amount of interest on these junk bonds. That affects the risk and is ultimately going to affect the value. And what we'll concentrate on in today's class is this firm's business risk that we can determine by looking at financial statements. So we'll look through financial statements. We'll say, is this firm a risky investment? Or is this firm a pretty sound investment? Because if it's a more risky investment, we're going to change the weighted average cost of capital. And a more risky investment, is it going to be a higher WACC or lower WACC? Higher WACC, exactly. It's going to be a higher discount rate, which is going to decrease the value of these cash flows. So, this will provide some context for us, just looking at a company's financial statements and determining about how much risk, how we can quantify it, how we can compare it to an industry standard. With that, I'm going to introduce Joe Finelli. He is a person with vast finance experience. He's actually been a mentor of mine for several years. He guided me through business school, talked to me about my aspirations in finance. And now, actually, it's not like we shifted positions. He still has much more experience than I do, but he told me he actually wanted to do what I did. He wanted to teach a little bit. I talked to him a little bit about that, and I said, why don't you come in for this class, because I don't know too much about financial statements, financial ratio analysis. Why don't you share your expertise with us on that? He has been in agribusiness and sugar and bioenergy for many, many years in a variety of CFO capacities. And I'm just going to go ahead and turn it over to him.
Okay. Thank you. It's a pleasure to be here. By the way, if any of you want to just chat about how you career finance and what that means, we can do that after we get through the material. I actually started out as a language major undergraduate. So I majored in French and Portuguese and minored in business. And then after I joined the DuPont company after I graduated, originally in information systems and then migrated into finance. Then went back and got my MBA. Eventually got a law degree. Was with DuPont for 34 years. The big joke is I had the DuPont method when I was in graduate school. I never used it in the 34 years that I was at DuPont. It doesn't mean that it's not a valuable tool. But I never saw it actually used in DuPont. And then after that, I left and joined the company I'm with now, which is Bunge Limited. We are competitors of Cargill and Archer Daniel Midland. Basically, we trade grains internationally. I actually spent 5 years head of strategic planning, then moved in as CFO for their agribusiness division, and I'm now their sugar and bioenergy division. So I'm pretty much on the road about 50% of the time. All of our sugar mills are in Brazil. The trading is in Geneva, so my life is New York, Geneva, and Brazil at this point. So we keep the bags packed, and JFK is my second home. Anyway, now you know something about me. What I'd like to know is something about each of you. What I'd like to know is what industry you work in, and some idea of just what you do, and if you've used financial metrics like this before. This will just help me kind of get oriented, and maybe we can use some examples from each of your different industries. You want to start?
Oh, okay. My background is my bachelor degree is material engineering, and I'm from China, and I'm an international student, so I'm not working now.
Okay.
Well, my undergrad degree was in forensic science. I was into all the CSI stuff at first, but I actually work in a human resource department for a manufacturer distribution company. So they design like outerwear stuff and products like that and clothing. And I decided I kind of want to go into the finance department and deal more with the numbers and everything than the people.
Good.
I work as a human resource assistant in a nonprofit organization. My undergrad was in behavioral science, but I've always had an interest in business, so I thought I would do my MBA.
Great.
My background is in construction management. Right now, I work for MSG as a supervisor for facilities, and I'm not big on financial, more management, general management.
Okay.
My undergrad degree is international relations and diplomacy. I'm from Ukraine. I just recently permanently moved to US. I've been a waitress all my life, but I just started working for Walker and Zenger, Marble Gal company, just like 2 months as an office assistant.
Excellent.
I'm doing my MBA just as a chance to be promoted and maybe work for international shipping company.
Very good.
I did my undergrad in sociology and psychology, but I've always been in finance career-wise. And right now I'm working for JP Morgan as a new accounts administrator.
Excellent.
I got my bachelor's in anthropology and Chinese language and studies, and
Fellow language major.
and I kind of look for doing Morgan Chase, and I'm going into legal investments.
My background is in accounting. I do work in securities accounting for a life insurance company.
Okay.
I got my undergraduate degree in accounting. I work for a nonprofit organization. So I'm in the finance department. So there's I'm the accountant and I have a payroll person as well as an accounts payable person.
6 credits of accounting, which was T Accounts 101 and T Accounts 102. But you learn things along the way, and I think that's the key thing. The other thing I will tell you is there is nothing that we do in the corporate world that you don't do in your personal life. And I'll try to point some of those out as we go through, because what I found is the first time that I went through this ratio analysis, you just had 20 different ratios thrown at you, and you look at them and you say, my God, what do all these mean? What you have to do is always take a step back and think about them in the context in which they're being used. What are they trying to measure? And when you get to the corporate world, which what we're going to be presenting is conceptually what the ratios are. Every company will use these ratios in one way or another, but they'll kind of redefine them as they see fit. So it's very much like accounting. When you go to school, you learn the theoretical accounting, and then you get into the real world working for a corporation, and what you find is what they do is slightly different. And if you went from one firm to another firm, you would find the second firm is going to do something else that's slightly different. So they're all conceptually, they're all within the same framework. But what you're going to learn here is going to be the basic concepts, but then you'll be able to apply them differently. Okay. So, what are ratios used for? And they really serve a number of different purposes. What I see them used for mostly in a CFO capacity is when we want to compare our performance to those of our competitors. So we want to see how we're doing versus how Cargill does. Or we want to see how we're doing versus Archer Daniels Midland does. Now, there's some difficulties in doing that. First thing is not everybody's statements are published. If you're not a publicly held company, if you don't have stock out there, you're a private company, you don't have to publish financial statements. So you may have competitors that don't publish. So getting financial data on them can sometimes be very difficult, unless they're doing a debt issue where they have to publish financials. So that's the first key thing. Second is how they do their accounting may differ. And if you're dealing with multinational companies, there is, which I deal with, there's US GAAP, which is the accounting standard in the US. There's Brazilian GAAP, which has slightly differences. So if you try to take a company who's using a different form of GAAP, a different form of accounting, and you pull information off of their financial statements and calculate the ratios, what you may get are some anomalies. As soon as you see that, you know you need to do some further investigation. If you go to a site like Bloomberg, which will publish a lot of these financial ratios, they have done that work for you. Because the analysts there, when they're putting together the financial ratios, go through and make adjustments so that when you look at the ratios, they're all apples to apples comparisons. But so one thing is to see how you're performing against other companies. Secondly, internally we use it to see how one business compares to another. How's the performance of one business doing versus another business? Or sometimes we do it comparing one geography to another. So why is the return on assets in Europe, the European operations, higher than the return on assets in Argentina? So again, it's a very good use, because what you're trying to get out of this is, if there's a difference and one is better than the other, what practices is that one following that's giving them a better result, and how can you adapt those processes in another geographical region? Again, some of the difficulties there can be that you have to always make sure that whenever you're doing these comparisons, you're comparing apples to apples. One of the issues you have when you start dealing with international is currency. In the last 6 months, the Brazilian real went from about 3.2 to $1 to last week it got to 4.2 to $1. So that has a huge impact when you translate that into US dollars. And so you may see a blip, and that blip may be caused by a rapid currency change, and it may revert back over time. So you have to look again to see, is when you're looking at these ratios, if you see something that looks wrong, is it because it's a structural issue, it's a fundamental problem in the inherent business, or is it a temporary blip that's going to correct itself over time? The other thing is that we use, especially the liquidity ratios, to determine creditworthiness. And we use that to analyze both our customers and our suppliers. Why do we do it with our suppliers? One, we buy grains. So we're buying wheat, we're buying corn, we buy soybeans, and then we resell them. And you make those contracts in advance. So we'll be buying contracts from Brazilian farmers today for delivery in their harvest next March or April. In the meantime, when we have the opportunity to sell them at a higher price, we book a contract to sell them. So we now have an obligation to sell them. What happens if that farmer goes bankrupt and doesn't deliver the beans, or doesn't deliver the corn, or doesn't deliver the wheat? We now have a contract out there at a fixed price to sell, and we don't have anything to sell. So when you look at creditworthiness, sometimes it's equally important to look at it from a supplier standpoint as it is to look at it from a customer standpoint. So let's look at the pro forma financial statements that we have for fictitious company A here. Anybody have any observations on the income statement if you look at it between 2013 to 2014? What do we see has had a significant change? Sales. Obviously, something has happened. They may have hired more salesmen. They may have come up with a new product, but obviously their sales has increased. Their cost of goods sold has increased as well, but you would expect that, correct? Because some of your cost is variable cost. So to the extent they had more volume of sales, they're going to have more cost. Interestingly enough, their depreciation went up, but not too significantly there. And their other expenses went down. Now I'll assume other expenses is probably their general administrative expenses. So it says they've also been doing some cost cutting. What's the net effect of all this? Oh, the other thing to note is, look, their interest expense is cut in half, which meant something happened with their debt. Either they retired debt and got cheaper debt because the banks weren't charging as much interest, or they got cash from somewhere and eliminated their debt. Right? So their interest expense was cut in half. The net effect of all that is, instead of having a loss of $95 million, they actually increased their net income by $350 million to get to $253. That's a pretty impressive turnaround in a year. Right? Does everybody agree? So that's looking pretty good. Now let's look at the balance sheet. Where do we see the big increases on the balance sheet? Don't be shy.
Short-term investments.
Short-term investments went from 20 to 71. Okay. Accounts receivable went up. Now, again, you might expect that would have gone up because their sales went up, correct? What we don't know is how much of that increase is due to just the volume increase in sales, and how much of that may be due that in order to get those sales, instead of giving customers 30-day terms, they had to give them 60-day terms or 90-day terms. Okay, so later on we look at the ratios, we're going to find out how efficiently they're using these assets to get to their net income. But one way increase your sales is to increase your market share. If the market's not growing, then you've got to take business away So, if you're out buying a car, as I said, you can relate all this to your personal life. If you're out buying a car and one dealership offers you a price and says you need to pay cash, and another dealership says you can pay me in 1 year for 0 interest, who do you go with? 0 interest, right? So, it's a way of capturing share. But there's a cost. The cost is your accounts receivable goes up. What else went up here? First of all, your cash doubled. Now, in today's environment, what do you get on your savings account? How much? But things got so bad. Switzerland, which has the strongest currency in the world, I think, actually the banks were charging people to keep money in a savings account because it's safe in Switzerland, safer than anywhere else in the world. But the one thing again that we would have to ask ourselves here is doubling your cash a good thing? If you're not getting any interest on it, it's not making any money, it's just sitting there. Right? So is that a good thing to be doing? Not necessarily. Now what we don't know, and this is again one of the limits, we're going to talk at the end about limitations or ratios. One of the things that you don't know when you just look at the numbers or even start calculating ratios is there a reason for this? There could be, when we look at the liability side of the balance sheet, that they have a note payable in 30 days. And remember, the one limitation you always have here is financial statements are at a fixed point in time, right? So, it could be that they've been accumulating some cash because next month they've got a payment they have to make. So if you look at the statement the next month, what you're going to see is that cash goes back to the 7 million level. The other big thing that went up is inventories. Again, their sales volume went up. That could be part of the explanation, but the question is, have inventories going up too much? Okay, and that's what we have to ask ourselves, and that's what the ratios are going to help us determine. Now let's look at the equity side. What do we see are the big jumps here? Notes payable got cut in half. Long-term debt got cut in half. What was the offset? There's something offsetting that decline in debt. Something else had to go up. Exactly. Your equity went up. Your equity went up by $1.2 million, which basically offset the reduction in debt. What would you think might have happened here? Somehow the company had to get, remember last year's earnings were negative. Even if you add back the depreciation, you barely get to a positive number. Right? We're 95 million negative last year. Depreciation was 116 million, you add that back, you get to like 10 million in earnings. Or in cash, I should say, EBITDA. So that says they didn't have a lot of cash to pay down debt. So they got the cash from where? From selling shares. So what this company did was they went out to the stock market and they did a new issue of equity. And then they took that equity and paid down their debt. Does that make sense? So basically what they did is they restructured their capital structure. And again, we'll look at some of the ratios, which will help us understand, was that the right thing to do or not. Now it's interesting because you can cross-check or triangulate. Look at what happened on the number of shares. What did they do? They had 100,000 shares. They now have 250,000 shares outstanding. So they went out and sold 150,000 shares. So we've now kind of proven our theory. The earnings per share, however, we had a big jump in earnings, 350 million, but the earnings per share is only up 6 cents. But that's because you're now calculating that on a much bigger base of shares. You're dividing that by 250 instead of 100.
It's negative earnings per share.
Well, it's negative earnings per share, but I mean, I'm sorry, you're right. It's up, but it's not up as proportionally as you would think looking at the earnings themselves, and that's because you have so many more shares that you're dividing that by. Get your earnings per share. Everybody following okay? The other thing that happened here is your stock price doubled. Who determines the stock price? How's the stock price determined? By the market. Right? That's what goes on in Wall Street every day. New York Stock Exchange. Theoretically, if you read the textbooks, the stock price represents the discounted cash flow of all future streams of cash that company's going to be able to generate. Now, in reality, any of you follow Wall Street, you know the stock price can be very emotional. Right? It's not always theoretically rational. But what this means is by taking some of the actions that this company took in terms of recapitalizing, that their investors, and remember their investors had to be pretty happy to invest because you just had another 150,000 shares sold. So these were new shares. So somebody had to buy those shares. So somebody believed that this company was going to do well.
Does that be reflected by the sales, basically? That would be the entree for people coming in to be willing to pay more for the stock because they see the sales really skyrocketing.
That's right, except there's usually a story that goes along with it. So, like I said, we don't know whether they came up with a new product, they've got a new technology that they just patented, which is going to give them extremely high margins for the next 10 years. If it's a drug company, for example, they just announced you'll see this kind of action all the time with a new drug company. They just announced a new drug that's patent protected for the next 20 years. It's going to cure whatever. The value of that stock just goes skyrocketing. So there's usually a whole story behind this besides the numbers, but clearly people believe in this company or they would not have bought 150,000 shares of stock. So it's not a surprise, therefore, that the stock price goes up. But the interesting thing, and this is kind of what I want you to get a feel for, is when you look at financial statements, there's a story behind there. Now the numbers will help, they will serve as indicators, they will serve as flags. They will help you identify where you need to probe further, but you need to probe to get the story. To me, that's why they're fascinating, is because there's a whole story behind every one of these financial statements. And as a financial analyst, that's what your job is. Part of it is to analyze the past so that you can help the business improve its earnings and its cash flow for the future. The other part is to project the future. All right, let's talk about liquidity ratios. Basically, what liquidity ratios are doing is they're measuring the company's ability to pay. And there's two ratios that are used. One ratio, and the other is called the quick ratio. Again, if we look at the current ratio, it's current assets divided by current liabilities. So therefore, if you had a current ratio of 1, that would say that your current assets or your current liabilities are equal to your current assets. Right? The higher the ratio, the better, because it says that you've got more assets than you have liabilities. Question for you all. Do you all have a current ratio? Your bank accounts? Your savings account? Do you own a car? Do you own a house? You have assets. Do you have a mortgage? Do you have a loan? Do you have a credit card? Do you've got charges accumulated on? And you've got liabilities. When you apply for a credit card, when you apply for a loan, when you apply for a mortgage, what is the bank looking at? Now, you don't publish your financial statements, but they ask you to put it all down on an application, don't they? So basically, you give them your income statement and your balance sheet. So every one of you has a current ratio. And the bank's going to look at that whenever you ask for money. Or a car dealership when you're asking to buy a new car, or if you're looking for a mortgage. So again, like I said, everything we do in the corporate world, we do in our own private lives. And if you can always translate it into your private life, what seems complex in the textbook will become very easy. Because really we don't do anything that complex in business. Except for the engineers that invent new products and whatever. That's complex. So if we look at now all of you gone through this, have you all gone through the calculation? But basically,
No, I don't think so. For the most part, they probably haven't, unless somebody printed out the slides early.
okay. But if we go back, basically these ratios are all balance sheet ratios. By that I mean they all come directly off of the balance sheet. And some textbooks will refer to it that way. You'll have balance sheet ratios, you'll have income statement ratios, and then you'll have cross statement ratios. But this is basically all of the balance sheet. So if you go to your current assets for 2014, you'll see 2.6, 2680. And if you took your liabilities, you'll see the 1,040,000. Everybody following? Now the quick ratio is basically the same, except you take inventories out of the numerator. Why do you think they do that?
It's going to take some time to get rid of that inventory.
Correct. Because if they're trying to measure how quickly you're going to be able to repay, let's say you've got old inventory or obsolete inventory. One of you mentioned you're in clothing, right? In clothing, what happens when it's an old style? Exactly. Right? Or if the clothing you made that year is the wrong color that nobody is buying, what happens to that inventory? You could have a ton of inventory sitting on your balance sheet, but it's worthless. So that's why in the quick ratio, all they're doing is they're removing the inventory. It could be obsolete, it could be slow, and you can't really tell that by looking at the financial statements. It's very difficult. So that's why they're removed. In the commodity area where I work, there was always a market for corn, wheat, soy. So when the credit rating agencies look at our ratios, they will give us some credit for that. They will discount it because they'll say, if you want to get rid of this quickly, you're going to probably have to sell it at a discount. So they won't give us full credit for that inventory value, but they'll give us some credit for it. you're in other industries, you won't get any credit for it. Okay, so the quick ratio is basically what we saw before, current assets over current liabilities, but we deduct inventories from the current assets, so we're not giving any credit for that. So again, this is what we see here in the calculation, our 2,000,006, subtract out the inventories of 1,000,007, and then divide it by our liabilities, and we get a ratio of 0.93. Now, those ratios, how do we know whether a ratio of 0.93 is good or bad or indifferent? Well, the only way to look at it is to compare it to the industry average. Why? Because every industry is different. In the commodity industry that I'm in, normally you would be turning over your inventory very quickly. Things are moving constantly. So you're working with a lot of working capital. There are other industries which were much more slow moving, especially in retail, some forms of retail. Cars don't necessarily turn over that quickly. So what you always do is you always want to look at these ratios against the industry average to see how well you're doing. Now this is also giving us some insight as to how well we're doing historically. So in this case, we're looking at both. So what this says is we're expected to improve, but we're still slightly below the industry average. And our liquidity position overall is not the strongest, but it is improving. Right? Okay, any questions on those two ratios? All right, let's move on to what we call asset management ratios, which are ratios which will help us determine how efficiently is a firm using its assets. And by the way, what we're going to be doing here is a lot of ratios dealing with the balance sheet. You can also consider, most companies, the other key asset they have is what? The number of people here work in human resources. What's the key asset? Employees. They're not on the balance sheet, but oftentimes they can be the key determinant of the success of the company. And you can use ratios, just like you can measure, divide your sales by your assets. You can divide your sales by your head count. So if I have X number of dollars in sales, and I have 100 salesmen, how much sales is each salesman generating on average? Okay. I could do that in the construction industry. How many workers do I have working on the project versus how much profit is that project generating? See, how much is each person contributing? The more efficient it's run, the higher the ratio. And we're also going to look at asset management ratios. Is how much does the firm have tied up in assets for each dollar of sales? So for every dollar of sales we have, how much are we investing? So the first is the inventory turnover ratio, which is looking at the cost of goods sold relative to the inventory value that's on your balance sheet. Now keep in mind, again, these are period statements. So you're looking at these ratios based on your income statement and your balance sheet at the end of a month, or at the end of a quarter, or at the end of a year. Now, let's assume that we had cost of goods sold of 100, and we have 100 in inventory sitting on our balance sheet. So your ratio is 1. What does that tell you? You haven't sold anything. Right? You produced $100,000 or $100 million worth of inventory, and you still have that inventory. If that inventory were 50, what's the ratio? says is you got rid of half of it. That's a good thing, right? You got it sold. If your cost of goods sold is 100 and your inventory is 200, what does that tell you? Not only did you not sell anything this month that you produced, but you didn't sell anything from, or you didn't sell everything that you produced in prior months. So you're accumulating. That's not a good thing. Because there's a cost tied up in that inventory. Right? You produced it, you're not getting any return on it. Okay. So again, here, this is a cross statement ratio, correct? Because we have to go to our income statement to get our cost of goods sold. And we're also adding in here our depreciation. Because the assets we're depreciating were assets. This is the cost of those assets to produce the inventory that we produced. So we add those two numbers together, divide by our inventory. And here we got a ratio of 3.45. Again, is 3.45 good, bad? We don't know. It's better than 1. We know that, right? It's not less than 1. So that's probably a good thing. But again, if we're talking retail, we're talking, if you're Dwayne Reed down the corner, that ratio may not be very good. Right? If you're in commodities, that may be really good. So the key thing is, again, we have to look at the industry average. What this says is the industry average is 6.1. So our competitors have got a ratio of 6. We've got a ratio of only 3.5. What does that tell you? Come on, don't be shy. Tells you we need to do some work here, right? If we want to keep up with our competitors are producing that inventory and selling it. They're turning it over. We're not. So we need to do something. So it may be, again, what's the problem here? It may be that we have old inventory. Maybe we're not able to turn over that inventory because nobody wants to buy it. Or it may be that we just have poor control. And we're producing, it may be that we forecast demand much higher than what that demand actually exists out in the marketplace. And so we produce more widgets than anybody's going to buy. When do you see that often happen? What's the big holiday coming up that everybody's already put out decorations for? Christmas. And what happens with Christmas with toy manufacturers? They overproduce. And especially what happens if the Cabbage Patch dog you produced is not selling this year? That's what happens. Right? So it's important again to what all the ratios do is send up a flag. The ratios say there's something right and we need to continue doing what we're doing, or there's something wrong and we need to figure out what is wrong and fix it. Now let's look at day sales outstanding. What day sales outstanding tells us is, for our average sales, how many days of sales do we have out there that we haven't recouped the money for yet? So we've invoiced, but we haven't collected. Now this is generally a function, what would you assume this is a function of? Every invoice has what? payment terms, right? Your credit card statement, when it comes in, what does it say? Due date, right? Okay? So, every invoice has a due date. Now, if your payment terms are 30 days, you would expect, and every invoice is 30 days, and you were collecting on time, you would expect this to be 30, right? If it's not, if it's higher, what does it mean? Either your salespeople, in order to get somebody to buy something, had to say, you don't have to pay me in 30 days, that's the standard, but I'll give you 60 or I'll give you 90. Right? That could be one thing. What's the other thing?
Post defaulting.
That's right. People aren't paying on time. That's why corporations have credit departments that are on the phone. And collection agencies that they'll send out after you if you don't pay. Right? Because what they're trying to do is just to get you to pay on time. So, if we look at this example, again, it's a cross statement calculation. What we're taking is the accounts receivable right off the balance sheet for the period. Then we're looking at our sales, but we're dividing it by 365 because we want to get it on a daily basis. So there's a little trick in this calculation. It's not directly off the statement, it's off the income statement, but we divide it by 365. It says we have day sales outstanding of 45 and a half days.
Then everybody knows they need to write that down, right? Unless you had the older ones off Blackboard, the answers aren't on there. Just jot it down. Give you all the information you need.
Again, knowing that it's 45 days doesn't help you unless you have something to measure it against. Everything's relative. Right? You know what Einstein said? Theory of relativity? Financial ratios, everything's relative. Either relative to another period, relative to another company, relative to another business, relative to another geography. Here the industry standard is 32. We're at 45. Do we have a problem? If you were the boss of the accounts receivable manager, what would you be telling him? Pardon?
It's taking too long to get paid.
That's right.
On the phone.
Or you call your salesman up and see if they're giving out too many deals. Exactly. Now, the other thing to notice is where are they going directionally? They're getting worse, right?
Yeah.
So whatever is going on here is getting worse year by year. So the diagnosis here is not good, and we're going in the wrong direction. Which basically is what this slide says. Okay. Now let's switch and go to a turnover ratio. A turnover ratio, you can also look at it as a productivity ratio. And I'll tell you a little tip that I learned years ago, and it helps you think about productivity ratios. Productivity ratios always measure two things: output in the numerator, input in the denominator. So, just remember that if you ever get stuck. Output in the numerator, input in the denominator. So you're dividing into your output to see how many units you're getting. If it's head count, it's dividing your head count into your sales, or whatever you're trying to measure. If it's assets, you're looking at how many assets, what your investment in your assets is versus how much sales each dollar of those assets is generating. Oh, jumped too soon there. So again, this is a cross-statement ratio. So we're looking at our sales number, which comes right off of the income statement. And then we're looking at our fixed asset, and I believe this is net fixed assets. You can also look at gross fixed assets. What's the difference between gross fixed assets and net fixed assets? Come on, I have two accountants here. And net, your accumulated depreciation, right? The gross fixed assets is what you bought those assets for. So if you invested $100,000 in a plant on day one, every year you're taking depreciation off, charging it against your income statement. So every year you're reducing what's on your balance sheet. That accumulated depreciation is what gives you your net assets over your gross assets. That's the difference. Why is one important, and why can you calculate the ratios both ways? What happens, and this happened all the time in DuPont, we would have a plant or a business that had plants that were 20 years old. They were almost fully depreciated. Then you would have a business that just started, had a brand new plant. So business one invested in their plant 15 years ago, and that plant is now only worth $50 million on the balance sheet. A new business starts up, and they've got a $150 million investment. Right? So if I use the net fixed asset approach, the new business ends up with a horrible ratio when you compare that to the old business. If you were comparing two companies, and you had a company that's been in existence for 50 years versus a company that's been in existence for 2, you're going to get the same effect. So sometimes you want to look at both, because this is where the age of the assets can come into play, and you want to see what those patterns are. Okay, now we go to total asset turnover, and now we look at our sales, which again comes right off the income statement, and total assets, which comes right off of the bottom line of our asset segment of the balance sheet. So what we're including here is both our current assets as well as our net fixed assets, right? We're looking at both. Again, that gives us, as you would expect, a much lower ratio because you're including the entire balance sheet. Now, again, let's look at how we're doing versus the industry average. On our fixed assets, we're doing better than the industry average, right? We're generating more sales per dollar of fixed assets. We're generating 8.4 versus an industry average of 7. Go. Doing the right thing here. Now, again, we have to ask why. Maybe our assets are newer than the average assets in the inventory. Or older than the average assets in the inventory, and that's what's helping us. But the interesting thing is if we then look at total assets, how are we doing? Not so good. And what's the difference between net fixed assets and total assets? No, one was total assets, which had net fixed and current. The first ratio, the fixed asset ratio, only has your fixed assets, right? Your permanent assets. This is your plant, property, and equipment. Your total assets adds to that your working capital, your current assets. So that's your cash, your short-term investments, your receivables, and your inventories. And when we looked at the ratios for receivables and inventories, what did we conclude? So what this tells you is that fixed assets, we're doing fine, but we're doing so poorly managing our receivables and our inventory that it's pulling that whole ratio down, and we're now below the industry standard. So again, all this is doing is confirming what we learned from some of the prior ratios, which is we're not doing a good job managing our inventories or managing our receivables. So again, a lot of times when you use these ratios, you want to triangulate and see if you get the same conclusion looking at different ratios that are related. Because if you are, that helps you confirm when you're drawing conclusions to your analysis that yes, I've got to be on the right track here. Make sense? We all good? Have I got you thoroughly confused yet? Just partially confused. Okay. So, the fixed asset turnover is expected to exceed the industry average. That's good. But the total asset turnover, because of our excessive current assets, is below the industry average. All right. Now we're going to... How are we doing time-wise?
Oh, we're great. Do you need to take a break or keep going, or that's the only decision to make?
That's up to you. I'm fine. But do you need a break or no? Okay, keep going. All right, now we're going to talk into debt management ratios, or these are also your capital structure ratios. Okay, it's giving you an indication of how much debt you have, how much equity you have. Do you have the right balance of debt to equity? And let's again let's put this in a context. What's the difference between debt and equity? Yeah, debt is temporary, isn't it? Maybe long-term debt, maybe a 20-year debt, but basically somebody's giving you money and says, we want it back, principal and interest. When you get money from a stockholder, what conditions come along with that? When you invest in a stock, what guarantee do you have of getting anything back?
None.
None. Exactly. I mean, if the company does well, they'll pay you a dividend. If the stock price appreciates, like this one just doubled, if you own this stock, if you were in the original 100 shares, and you own this stock at $7 and it went up to 14, you're a pretty happy person, aren't you? You just doubled your money. But equity, the difficulty with equity is there's no guaranteed payout. But, we talked about, and I know you're going to get to this later in the class, the weighted average cost of capital. What you will find is the cost of equity is much higher than the cost of debt. Why? Because you don't guarantee your shareholder anything. So the shareholder says, I got to take more risk. So if you want me to give you money, and you're not guaranteeing me a dividend or guaranteeing me a capital gain, there's a cost for that. My expectation's higher. The bank, however, is giving you a loan, right? There's terms to that loan. It has to be paid in a certain period of time at this interest rate. Sometimes the debt holder also takes a lien, correct? Meaning there's collateral involved. So we will give you this loan, like the mortgage on your house. How many of you own a home? Okay. You get a mortgage on the house? What happens if you don't pay? The bank says, I got a lien on the house is mine. I'm taking it. Car loans. What's the collateral for the car loan? Car. Car. You don't pay the bill, somebody's picking up that car. And it's gone back. So, therefore, the cost of debt is less than the cost of equity because there's less risk. So, any company wants to therefore balance how much equity they have with how much debt they have. And there's a lot of factors that come into play there to get the right capital structure. But you want to leverage your debt because it's cheaper, but you don't want to over leverage yourself. Now, this is going on right now. I can tell you out of my own personal experience with sugar mills in Brazil. Right now, margins on sugar and ethanol are not terribly high. And a lot of these mills have a lot of debt, and a lot of that debt is US dollar denominated. The real just went from 3.2 to 4.2. What that says is, for every dollar of debt that they have to pay back in their currency, not 3.2 reais, but 4.2 reais. That says they got to earn a lot more money in real in order to pay back that debt. There's a lot in default. We've got mills coming to us saying, we will, give you sugar next year when we produce it, but we need you to give us a loan of $50 million. And as CFO, these kinds of deals come to me. Now, would I approve giving $50 million when I don't know what their harvest is going to be? I don't know if they're going to produce sugar next year. And they're in debt up to their ears and they can't make the payments today. I might as well just, send my money off to the Little Sisters of the Poor or whatever, because there's no return here. Right? But this is what's going on right now in that particular industry. And you'll see cycles like that go on in industries. Construction industry is a great example of that. There are times when everybody's going gangbusters, you got a huge amount of money, they're all out getting loans to do the construction, and then all of a sudden things start falling apart. Things end up costing more than they anticipated, wages go up, what have you. Somebody that's supposed to be supplying you equipment or supplying you materials goes bankrupt and you can't get them and it slows down the job. Happens all the time, right? So you have to be careful that you don't over leverage yourself because you're exposed on that debt. Remember, that goes back to the quick ratio and the current ratio. How well can you pay back? How well positioned are you to pay back that debt? Equity, you don't have to worry. You just don't declare a dividend. You say to your shareholders, sorry, we didn't make any money this year. You don't get anything. Doesn't cost you anything. But with the debt, you could lose your assets. When you lose your assets, you don't have any ability to generate more product. It's a downward spiral. So what we're looking at here is does the company have too much debt, and can the company's earnings meet its debt servicing requirements? The minimal debt service requirement is always the interest. But then the bank is also expecting you to pay some of the principal. So if we look at the debt ratio, we're taking our total debt to our total assets. So again, this is a balance sheet ratio. We go to the balance sheet and we take our notes payable as well as our long-term debt and divide that by our total assets. Now, a balance sheet is called a balance sheet. Why? Pardon? Exactly. Your assets have to equal your debt plus your equity, right? So, for you mathematicians here, if I take 1 minus this ratio, what do I get? Come on, the engineer back there is going to know that. I'm going to get the ratio of my total equity and my total assets, am I not? In a lot of ways, these ratios are basic math. So again, don't let them get to you. They sound a lot more complicated than they are. They all have fancy names and words. But if you think about them, all they're giving you is two different perspectives. Because your debt and your equity have to equal your total assets. What this says is I've paid for 22% of my assets in debt, which means I have to be paying for the rest rest of it in equity. Right? Now, here we've just inverted the ratio, if you will. In the last one, we had our assets on top, we had our liabilities on the bottom. Now we're just inverting. So it just gives us a different perspective. So here again, but we're taking our total liabilities here. So I believe we've included our payables, correct, and our accruals. Sound right? By the way, does everybody know what an accrual is? Wait till we finish writing. But does everybody know what the concept of an accrual is? When do you take an accrual? Come on, I have two accounts here. Well, you could for accounts receivable if you have a doubtful account. If you don't think you're going to be able to ever collect from that customer, but you think there's still a possibility, then you do an accrual. What happens if your company has a lawsuit? If you think, normally you don't like to take an accrual in a lawsuit because the attorneys on the other side will say, see, they thought they were guilty because they already took the accrual and they put it on their balance sheet. But you could have a tax liability where you think, when your lawyers say, you're going to lose this case and you're going to have to pay this money to tax authorities, U.S. GAAP requires you to recognize it on your balance sheet. So that's what an accrual is. An accrual is kind of tucking money aside for an obligation that you're going to have. And it actually has to meet two conditions. One, it has to be probable and it has to be estimable. So it means it's got to be more than a 50% chance of occurring or higher, and you have to be able to estimate what the cost is. Sometimes you can't do that. With a lawsuit, for example, you may not be estimating what your settlement's going to be. So then you don't have to take the accrual. It's a very gray area in the accounting rules. And so, but it's very tricky for a shareholder because if you're looking at somebody's financial statements, you want to know how much liabilities they have sitting out there that they may get hit with because you don't want to buy their stock and then find out a month later that they had this huge lawsuit sitting out there and they're going to have to pay out a huge sum of money. Okay. Times interest earned. What this says is, if this is my interest expense, how many times have I earned that in my earnings before interest? So if you think about it, it's kind of another measure. It's almost like a liquidity measure. It's saying how well can you service that debt? How much income are you generating to be able to pay down your interest? Recognizing that you can sometimes convince a bank not to foreclose as long as you're paying your interest. They want the interest in the principal, but if you can at least pay the interest, the banks will give you a chance, particularly if you start to enter into Chapter 11 bankruptcy. So again, we go right to the income statement. It's an income statement ratio. We look at what our EBIT is. We look at what our interest expense is, and we calculate the ratio. The higher the ratio, the better, because this tells us how many times we earn that interest expense. So again, if we look at the ratios here, what it says is that again, times interest earned, we're on the industry standard. Now, we didn't do so well in the last two periods, but we're okay now. Okay. When we look at our debt to total assets, look where we were. We were at 35%, then we leveraged all the way up to 60%, and now we're down to 23%. So we did something to remedy that, right? We decided in 2013 we had too much debt. So we reduced the debt. Now, do you remember when we went over the balance sheet at the beginning of class? What did we determine? Our debt went down by $1 million, and we issued 150,000 shares of equity. And our equity went up by $1.2 million. So we used that equity, we used the proceeds we got from the sale of the shares to pay down the debt. Therefore, you would expect that these ratios would come more into line. Right? So that's what we did. That's why you're seeing this jump here. And that's also having an impact on your total liabilities. Because your debt is the key component of those total liabilities. So again, it's tying in. You can feel good. So recapitalization, and that's what we mean by we issued equity to reduce the debt. Now let's look at the equity multiplier. And we already kind of looked at this. Again, this is the inverse of what we looked at before. This is total assets over common equity. It's telling us how many times or how much more we have in assets relative to the amount of equity. Again, it's a balance sheet ratio. So we pull off total assets right from the balance sheet, right from the total asset line, last line on your balance sheet on the asset side, and we divide that by our equity value. And we get a ratio of 1.8. Again, if we go back, because we issued all those new shares and our equity value went up, as we would expect, the ratio would go down between 2013 and 2014. So now we know what's driving that ratio down. All right, let's talk about some profitability ratios. Profitability ratios really deal with a given, again, this is output over input, based on our sales, based on our asset base, how much are we generating for each asset in terms of sales, in terms of net income. We also call them profit margins. So you can calculate a profit margin on net income divided by your sales, and these are income statement ratios. So what this says is for every sales dollar that I have, how much of that did I convert into net income? And what's the difference between my sales and my net income? All my expenses, right? So it says, how well did we do managing our costs? You can also do it on EBIT. You can basically do it on any subtotal that you have on your income statement. So some companies you'll see a number that's gross margin. For our company, that's what we look at. We look at our sales less the cost of the materials. So if we're selling wheat, we look at the sales of the wheat less what we bought the wheat for. That gives us a gross margin. Then we start taking into account other processing costs, and we do an operating profit line. So every company is going to have a different breakdown on that income statement. You can take any of those breakdowns, whatever they're called, and relate them to the sales number. So again, if we look at our 2014 income statement, what we're going to see is net income was $254, 53.6. Our sales were $7 million. So basically, our margin was 3.6%. We look up our operating profit margin, which is our EBIT number. So this is before interest and before taxes. So we would have a higher number here, which is our 503. Divide that by the same denominator, gives you a ratio of 7.1. Again, is it good or bad? We don't know. But we got to look at the industry average. So we're And we've also made significant improvements year on year, both in terms of the profit margin on net income as well as the operating profit margin on EBIT. Now again, we weren't doing so well in the past. We really improved in 2014. Remember, in 2014, our stock price doubled. Do you think this had an impact on it? Absolutely. If you were an investor, would you invest in this company in 2013? Probably not. Would you invest in 2014? Looks like a better deal, right? All right, now we're going to get to return on assets, which is net income over total assets. Again, it's how much income are we generating for every dollar that we've invested in our assets. So we look at our net income again at 253.6. We divide it by our total assets, and we get a ratio of 7.2. We can also do the same, and instead of dividing it by total assets, we can divide it by our common equity. What this is going to tell us is for every dollar that the shareholder invested, how much are they getting back in net income? Right, so if you're a shareholder, both ratios are important, but this ratio is probably even more important to you. So again, versus the industry average, what this says is our total return on assets, while it improved from last year, is still a bit low, right? It's 7.2 versus an industry average of 9. But what did we determine? We haven't been using working capital very well. And working capital goes into that calculation. So again, it's another indication to us that our inventories and our receivables are too high. We got to do a better job managing these. And if you look at the industry average, our return on equity is also a bit low. So it says our shareholders are probably expecting us to improve. And the way we do it is we've got to generate more income for them, right? So it says we've got to reduce our cost. So again, this gets kind of the effect of leveraging. Your return on assets is lowered by your debt, but on the other hand, you have interest expense, which is lowering your income, which also lowers your return on assets. But when you use debt, the use of debt then lowers your equity. So the more debt you have, right, the less equity you need. And if the equity is reduced by more than net income, your return on equity is going to increase. So you're playing with the numbers. The best way to figure this out is write down the ratios, plug in the numbers, and look at what's happening mathematically. When I want to do an exercise like that, I just plug in fake numbers. These simple numbers like 100, 10, 50, whatever. You got to make sure they balance, because you're dealing with a balance sheet here. But just play with them and see what happens as you vary them. Vary your debt, vary your equity. Assume a certain interest expense. Go through the impact of what that's going to do mathematically. And that'll help you get a better feel for how these ratios work with each other. Sometimes it actually is helpful to do that. Even though I've got over 44 years of business experience, I go back sometimes and play with numbers. Just to make sure that I'm fully understanding and appreciating the connections, the relationships between ratios. All right, let's talk about the DuPont system that I never used in the 34 years I worked at DuPont. Basically, it focuses on expense control, it focuses on asset utilization, and it focuses on debt utilization. That's your debt to equity ratio. And it shows how these factors combine to determine ROE, return on equity. Now, This model is a little more complicated than this one. The supplemental sheet you have calculates the return on investment or the return on assets. So forget about this segment of it. Okay? What it's really doing is it's giving you your profit margin times your total asset turnover. And again, very simple math here. You take your net income and your sales, you multiply it times sales over your total assets. Your sales, basic math, your sales cancel out, so you end up with net income over total assets. Now, why do you break it into your components? Because if I look at my net income over total assets, and I don't like the answer, it's less than the industry average, I need to start looking at what's causing that. Where's it coming from? What the DuPont method allows you to do is begin to analyze what is the source of the problem. So in order to do that, you then have to break it down into these two ratios, right? Which is what this sheet will do. You see, you have your return on investment over here, or your return on net assets. There's different nomenclature, but it means the same, which is also why this stuff kind of gets confusing, because every textbook you look at it, slightly different terminology. And that gives you your asset turnover over your profit margin. Now, what this model does is says, okay, if I determine, as we did here, that our profit margin is okay, then we know the problem is probably coming from our asset turnover, correct? So now we start looking back, and we say, is that coming from our operating income, or is that coming from our assets? And then we look back and we say we have current assets and fixed assets. And when we looked at those ratios, what did we determine? We were on the industry standard. We were better than the industry standard on the fixed asset ratio, weren't we? What was our problem? Two areas we had problems. Anybody remember what they were? Accounts receivable and inventories. So, where the problems were coming in were over here in this column, in the far column. So see how the DuPont model can help you work your way back? So that you can figure out exactly where on your balance sheet or your income statement where your problem source is. And you can't fix the problem unless you understand where the problem's coming from. Okay? Now this still doesn't tell you what the actual source is, right? We know we have a problem in receivables. We know we have a problem in inventory. What we said was we're not sure whether our problem in inventory is because the inventory is obsolete, whether it's slow moving, whether we just produce too much, right? Isn't that what we said? So there's still, we have to do some more investigatory work here. Used to do CSI. Right? This is forensic. This is essentially what you need to do. You need to keep working back, questioning, and what the ratios do is they send up flags. The ratios will help you say, this is the area I need to look at. But then you got to get in depth, and look at what are the practices versus what are best practices in the industry in order to determine what exactly am I not doing well. In accounts receivable, is it because I don't have a good credit policy? Is it because I'm granting credit when I shouldn't be? Is it because my payment terms are larger than they need to be? Is it because I'm not doing a good job collecting? I'm not paying attention. What's the one industry that has the most significant problem with receivables? Anybody know? Which industry is traditionally bad at that? Credit cards, but usually credit cards are on top of it. Hospitals. First of all, their billing systems are outrageous. So you ever gotten a hospital bill? And you look through it, you can't understand it. You don't know what they're charging you for. There's probably 50 things on there that had nothing to do with you. There's the patient next to you that they happen to put on your bill, right? So every customer is disputing the bill from the get-go. Now you're going to pay a bill that you don't agree with? No. So you have a huge dispute there. Then they have to put claims in against the insurance companies. If they put a claim in and the insurance company says on line 3 you have to enter this, and somebody misenters something on line 3, guess what the insurance company does? They send it back. So now they're going through this endless process, clerical process, of trying to get the claim processed, and if they don't process it correctly within so many days, they lose the money. So hospitals are the worst of this. And there are consulting companies that do nothing but go into hospitals and help them fix the problem. Because it can all be fixed. And a lot of it is just human error or bad practices. But this is where the forensic piece comes in. This is where the ratios will help you say, your receivables are way out of line, your day sales outstanding are way out of line. But you've got to figure out why they're out of line and what you need to do to fix your procedures and to train your people or whatever else you need to do so that you improve the numbers, which in turn improve the ratios. Now, what this formula is doing, all this formula is doing is basically what's on that long sheet, which takes you to here. And now they're multiplying it times your debt to equity ratio in effect to find out just what is the impact in terms of return on equity. If you only go to here, you do your return on assets. If you go to here, you're just breaking it down onto your return on equity. So it's a little more complicated than it has to be. But it's a great, it actually, even though I've never used it methodically, I have used it sort of intuitively. You know, where you just kind of go through this analysis in your head and you say, okay, I know that there's something wrong here. You look at this number, you say, okay, that looks like it should be okay. So you look at this other number until you kind of get things pinpointed. Okay. I'm not going to take you through each of these calculations, but basically, if you go back and pull the numbers off of the statements, you'll see where these ratios are coming from, and you're just multiplying them across to get to the numbers that are here. Again, what this says is, from an industry standpoint, in 2014, our net income to sales, we were okay. Sales versus total assets, we didn't do as good, right? And we know that from working capital. And then all this is doing is giving us then the return on equity versus your return on total assets. All right, let's talk about some of the limitations of ratio analysis. First of all, it's often difficult to do your industry comparisons when your companies are different. So as I mentioned, my company competes with Cargill and competes with ADM. First of all, Cargill is privately held, so they don't publish quarterly financial statements. They do have to publish some, however, so we do get data on them. But the problem is Cargill is a huge conglomerate. So Cargill produces meat, they have cattle. They produce chicken, they produce feed, they produce a number of products that we don't have. They're a much bigger conglomerate. So therefore, when you look at the ratios, you get a multiple industry perspective in Cargill that you don't when you look at our company. Now, our company's not small. It's a $60 billion company in terms of revenue. But still, we're more focused in terms of the product lines that we're in, so it makes the comparison very difficult. Seasonal factors can distort ratios. Let's go back to the toy example. Toy companies are going to build up their inventories right now because they have to get them into the stores in time for Christmas, right? So they don't know how many of this new doll that they're going to sell, but they have to assume that it's going to be really popular. So they're manufacturing all those dolls so they can get them in the stores in September so they can all be sold by December. So when you look at their inventory, what you're going to see is certain periods of the year that inventory is going to build. So if you look at the ratios when the inventories are at a very high peak, you're going to get a different perspective than if you wait until they've actually sold them into the stores and those inventories come down. So what you have to do in ratio analysis is take into account those seasonal factors. Certain industries are seasonal, some are not. Window dressing techniques. Again, I mentioned a couple of times that these statements are based on one period in time, month end, quarter end, year end. I will tell you, there's a push on in our company to get inventories and receivables as low as possible at quarter end and definitely at year end. They only have to be down for one day, December 31st. So you try to hold back all the payables that you can. You try to collect all the receivables that you can. You try to get rid of all the inventories that you can. And they may zoom up on you January 2nd. But that's okay, because the credit rating agencies are only looking at December 31st. That's window dressing. You didn't hear me say that, by the way. But all companies are going to do that to a certain extent. So, it's, again, that's why you need to kind of look at things and look at things in context. And finally, we've already talked about this, different accounting and operating practices can distort the comparisons. Sometimes it's how companies depreciate, because when if you have an expense, you either have to capitalize it, meaning you put it into your asset base, right? Or you expense it on your income statement. Different companies have different policies. For example, when they have capital expenditures. So what counts as maintenance normally gets expensed. What counts as a capital improvement gets capitalized. Those policies, US GAAP allows for a certain leeway in those policies. So how companies apply those policies will have an impact then on what shows up in their financial statements. Again, what you have to do is do a little bit of reading. If you look at income statements, or if you look at, I should say, published financial statements, there will be footnotes. There will be more footnotes than the pages of financial statements. There can sometimes be 30, 40, 50 pages of footnotes. How anybody can read them, I don't know. I have to read them for my business because accounting wants people in the business to sign off on it. It's barely, it's hard to stay awake after the first 3 lines. I only read what is absolutely necessary for me to read because it is really painful. But it's all part of the process. But the other way to do it is go to a source like Bloomberg, because they've done all that for you. So there are other ways of shortcutting the process. And that's it. We got done on time.
Awesome. Thank you, Joe. As you can see, Joe brought a lot more context and perspective than I would have been able to because of his vast experience in accounting. I'll say 2 things. One, in terms of the quiz that you'll take next week, it's just the basic calculations. You won't have to know how to drive down your inventory right on December 31st. And those little tricks will not be mentioned on the quiz. So if you didn't get any of those written down, I can kind of scroll through them, or you can also pull up the slides on Blackboard, which have all the answers down. So it's just those basic calculations and a little bit of intuition that you'll be responsible for. The other thing I would say is, while Joe's here, if you want to ask him any questions about finance or his experience in finance or how we can leverage our MBAs to expand yourself professionally in finance. I would take advantage of that now. Anyone have any questions? Greg?
Joe, you indicated you really work in the commodities area, and so the question I have for you is, why are commodities such a bad investment these days? And is that going to change anytime in the near future?
Well, first of all, commodities are commodities because basically what the word means, they're the kind of the basic things. Now, there's good news and bad news. The good news is everybody has to eat. So selling corn, wheat, rice, soy, being the largest vegetable oil producer of the world, which we are, we crush canola, we crush sunseed, we crush soy, sugar, are all things that people need. And what do we know? We have a growing population in the world, so demand is there and ever growing. And so it's not a bad business to be in, right? We don't have to worry about being obsolete. Unless somebody comes along with a totally plasticized equivalent of food that you just inject in your arm or something.
Well, back to your point that you were saying earlier, basically one of the reasons why this company, they had a lot of sales, we were just looking at had a lot of sales, people bought stock. People are not buying commodity stocks these days.
Correct.
You know,
But I'll get to that.
Why are they not?
Right. But I was going to say, the good news is there's always demand. You're always going to have a business. The bad news is the margins are paper thin. The margins are paper thin. When I worked at DuPont, and DuPont invented things like nylon, Lycra, Dacron, Orlon, they all had 20-year patents. Teflon, you know, the stuff that they coat your pans so that they have no stick. You had 80% gross margins. A monkey could run the business and be profitable. You could make a lot of mistakes. Our margins are 2%, 3%, 1%. Okay? Now, that makes it a very tough business because you have to watch your cost constantly. Now, what happens, why are people in and out of commodities? Because commodities are basic. So what happens is, when the market kind of goes into a boom period and techs get high and everybody wants to buy stock in Facebook and they want to buy stock in Apple and they want to buy stock in all these biotech companies, pharmaceutical companies, what have you. When the market tends to turn a little bit and start coming down, and people are concerned about inflation, they're concerned about economic risk, balance of payments, what's going to happen in Washington, etc., then they get out of all those stocks and come back into commodities. So it's cyclical, and you can kind of trace the trend. We would rather not have them trade there because when you're in commodities, we have a cash business, that is, we're physically buying wheat and selling wheat. But because you're doing all those contracts in the future, you have to protect yourself, and we protect ourselves by going into the commodity futures markets. So we're buying wheat futures and selling wheat futures, etc. There's money to be made on those futures, which helps supplement the margins on the physical business, which are so thin. Okay? We trade based on, we have research people that do nothing but research what the production is going to be from every country that's producing every one of those commodities and what the demand is going to be from everyone. And we're looking at supply and demand curves and what that means in terms of the price going up, is the price going down. The hedge funds, the banks, and at this point there's only, I think, Goldman and one other bank, Morgan Stanley, are the only two that are still in commodities. The rest have all gone out because of the new banking regulations and because there's not enough profit to be made. But they come in, and particularly the hedge funds come in, and they're like day traders. So they're not there for the long term. They're not protecting a physical business. They're there just to get the price, you know, just to get a capital gain. Could be in a day, could be in a week, could be in hours. So the problem is, when something happens and there's a notice that right now, it's been raining in Brazil this week. What that means is you can't cut the sugar cane. If you can't cut the sugar cane, you can't mill the sugar cane, which means the production of sugar and ethanol is going down. We're losing production every day it rains because you can't get the machines into the field because they get stuck in the mud. And you can't store cane. You have to mill it within 24 hours when it's cut, or you lose the sugar out of it. So you have to mill it and cut it. Cut it and process it immediately. So if it's raining, you're not cutting anything. If you're not cutting anything, the plant's not running. They will hear news like that, and they will immediately say, okay, the price is going up on Guan Long. And then they'll force the price up some incredible amount. The other thing that they've all started doing is they started algorithm trading, which means they have computers that are looking at what's happening within the market price every day, and the computer's generating orders to buy or sell futures. Not human logic. They're not looking at the same data we're looking at. So basically, they screw us up. Because our traders are trading based on data that we have. They're just playing in the market. But because of their actions, it can force prices up or down. So again, that can also sometimes discourage people from, if the markets are rallying or people lost a lot of money in it, then what you'll see is there's a bad quarter and the hedge funds end up losing a lot of money, then they'll shift out of commodities again. That's shorter cyclicality. The longer cyclicality is the overall world economy. And it's not, you can't even look at the US economy anymore. Because our economy is so tied to all the other major countries of the world that you got to look at what's happening in Europe, you got to look at what's happening in China, you got to look at what's happening in South America, because a blip in any one of those major countries is going to throw everything else out of whack. So I don't know whether I answered your question or not, but it's not. It's hard to make a buck some days. Any other questions?
Does anyone want to represent the typical Mercy College student and say, this is my background, how would you recommend I proceed with my career in finance? Frida.
Well, Frida, and I work as an HR coordinator in a manufacturer distribution company, and I'm trying to get into more finance. And I guess I'm kind of looking for advice on how would I go about it. Like, I got a little bit because my boss is kind of helping me move into our department, but our finance department is kind of small, so I'm looking for something where maybe I could be more on a special project or something like that. So I don't know if I really want to stay with my company and more basic with the finance.
Yeah, I mean, that is always a difficult decision that you have to make in terms of if you've got a good reputation in the company and you've got a company that's willing to give you a chance. Because what a lot of companies do, particularly if departments are relatively small, they only want to hire people with experience. Now, the company that I work for has been good because they have allowed people to shift from one field to another. I mean, with the right educational background, what have you. But they've allowed people to do that, people that have proven track records in what they've done. Not all companies will do that. So what you have to determine is what is your probability for success? And the other thing you have to look at is how long have the people that have been there been there? And if they've been there forever, then there's not going to be a lot of movement to create new opportunities.
Right. Yeah.
In which case, I mean, I'll be perfectly honest, you're better off looking someplace else.
That's how I feel. So, and my boss is like, but I'm like, some people been there as old as I am, 28, and they've been there 28 years. They're not going anywhere.
Well, and what you can do is, if your boss is willing to give you a special project that's going to help you get oriented, take it, do it, because you can put it on your resume.
That's always my thing about starting at least is probably just to have something on my resume, because I was a little worried with no experience in finance, and I don't know how, if I did get my MBA, if they would still want to take a chance on me with no experience somewhere else in another company.
And I would try to stay in the industry that you're already in. especially if you want to do, I mean, one of the things you need to think about is if you don't have a degree in accounting, it's hard to get into the accounting part of the business because for most people want accountants that have a degree and have been certified. So it's harder to get into that side of it. It's easier then to get into financial analysis and planning, to get into treasury work, to get into it. Another great place to start is internal audit. Okay? Because internal audit, now some internal audit firms will be much more focused on accounting, but I spent 2 stints in internal audit. And what I find is that, again, you have to look at the company and see how it's structured. But as an internal auditor, what you're going to be doing is going around evaluating processes and writing up recommendations as how they can improve controls. You will get a touch of accounting because you're going to need to understand that to be able to look at some of the stuff you're looking at. You'll get to understand something about their treasury operations, something about their risk operations, something about their tax operations, and you'll start to pick up little bits and pieces. And then you can also, the other thing that internal audit, because you're getting to see all these different areas, you can then start to say, okay, I think I kind of like this work better than this work over here. So it gives you the opportunity to kind of sample it. And it also gives you exposure to all these people. So that if you put your best foot forward and they like you, and then you go back and talk to them and say, I would really like to work in your department. They've gotten some exposure to you, they know you, then there's a pull. So that's also a good way to start in any company. Because it's financial, but it's not heavy financial in any one area. Now, most of my career I've spent in financial analysis and planning, which is basically doing things like analyzing results, preparing presentations to present results to corporate management or to boards. It's analyzing capital projects or investments. I've done a lot of M&A work, mergers and acquisitions work, negotiating deals, that sort of thing. And it's, so you do spend time analyzing the historical, but you also spend a lot of time projecting the future. Now, not everybody is comfortable doing that. There's kind of a joke, but I've heard of people that do it. If you're on a job interview, they'll say to you something like, you have got 15 minutes. Someone's asked you to determine what is the volume of water in the world. How would you go about it? And what they're interested in is not the answer, but your thought process. Are you capable of taking something? Because when you're projecting next year's earnings, there are 10 million factors that could go right or wrong. It is not a science. So you've just got to kind of look at the assumptions, look at what you think is going to happen in the world, look at what you think is going to happen in your world, and come up with a projection. This is what we think our sales are going to be, this is what we think our margins are going to be, this is what we think our costs are going to be, this is what our income is going to be, this is what our assets are going to be, this is what our return is going to be. But you're always dealing with the unknown. Now, I love it. Some people hate it because they'd much rather have, and this is not picking on the accountants, but accounting is much more disciplined, much more structured. I mean, there's a lot of thought that goes into it as well, but you're dealing with numbers, you're dealing with facts, things that have already happened. So you don't have to deal with that unknown and that feeling of uneasiness when someone says to you, well, why do you think costs are going to go up 10%? I mean, you got to have a rationale for it, but who knows whether it's going to be 8%, 10%, or 12%. You just give it your best shot. That's really the difference. Treasury is an area that is much more tied into banking. It's understanding capital markets. There's sometimes can be a lot of math involved because you're looking at how to leverage the interest rates, where you can get the best interest rates, how you can structure loans. Again, it's usually what you'll find is in any one of these areas, people love what they do, or if not, it's going to drive you nuts to be working here if you're not happy with it. You got to have a passion for what you're doing. And then risk area is another area, whether you're analyzing credit risk, whether you're analyzing the risk of the company. Again, it's very analytical, but it's interesting work because you're very closely tied to the business. So again, some of these assignments will be much more tied to a business. Some of them are tied to much more sort of corporate offices. What did I miss? Tax. I could never do tax. It's too tedious. You've got to go through every law and understand the implications of it. I mean, for any of you who try to calculate your own income taxes, multiply that by 10 times or 20 times, and that's what you're dealing with in tax. It's far too tedious for me. I could never do it. But again, people just absolutely love it that are in it. So anyway, hopefully that's helpful. I wish you all luck. Hopefully the environment will get a little better. It looks like there's more and more employment opportunities coming along, so hopefully the American economy is on the right course. That'll make things a lot easier. Anyway, good luck to you.
Thank you.
So I'll be around if anyone wants to ask questions about the first 3 classes. Make sure you're caught up on everything. Otherwise, I'll see you next week.